Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I am President, Partner, and Chief Compliance Officer of SilverOak. With me today, as usual, is Jonathan Charlo, also a partner with the organization, as well as our lead analyst. Today's webinar is scheduled to last approximately 30 to 45 minutes. We did change up the webinar just slightly to shorten the length. It had been running around 45 to 60 minutes, so hopefully we can get through the materials just a little bit more quickly today without really having given up, we don't think, much content. We will post a copy of the webinar to the SilverOak website within the next few days. If you have any questions throughout today's webinar, please feel free to contact your SilverOak advisor. If you're not currently working with an advisor, feel free to contact me directly at 952-896-5701. And as usual, I also want to thank Jonathan and John and the rest of the team here at SilverOak that work so diligently to make this webinar happen. It does take a village to pull all this together. For compliance purposes, since I am the Chief Compliance Officer, I must note that we will be discussing the overall markets and economy during this webinar. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we will not be discussing specific SilverOak portfolio performance, as each of our client portfolios are customized. Nonetheless, all of our clients should have received their customized performance reports within the last couple of weeks. If you have specific questions regarding those reports, feel free to contact your SilverOak advisor if they've not already contacted you. And lastly, past performance is no guarantee of future success. So, with that, Jonathan, let's look at the agenda for today's webinar. We'll start with a discussion around economic data. We'll transition into a discussion around the market data. Then we'll talk about SilverOak's outlook moving forward. We'll provide some SilverOak updates and other important reminders. And we just added in a small section on Minnesota tax conformity. If you're not aware, Minnesota did pass conformity rules that now bring our tax system more in line with the federal system after the Tax Cut and Jobs Act was passed on the federal level. And of course, we encourage any questions, as I just mentioned, reach out to your SilverOak advisor. And even if you have suggestions on what topics you'd like to hear in future webinars, please provide that feedback as well, even if it's not necessarily questions, but just some guidance for us going forward. So Jonathan, you put here modest growth during the second quarter from an economic perspective.
Absolutely. We'll show in the dashboard and different slides, but another way we could have put it is mixed signals, because certainly we're seeing some positive consumer side of the economy, whereas the business and business investment side has definitely detracted.
But overall, we continue to grow. We saw some GDP numbers, which we'll touch on a little bit later. They came out this morning. And as of July 1st, it looks like this economic expansion has entered its 11th year, which, if people aren't aware, that's the longest running expansion in history, at least for the US. We'll touch on why that might be the case in a few slides, because it also has been maybe not the most robust recovery over that 11-year period. But let's start with the dashboard. And everybody should be aware that we started putting this dashboard data together several years ago. It is made up of 4 different components. And what we're going to look at right now are each of these components, starting with the economy. Each of the boxes represents a different period of time. So starting at the far left, third quarter of 2016, then fourth quarter of 16, then 17, 18, and 19, with projected numbers going out for the rest of this year into early next year. If the box is green, that's a positive sign. If it's gray, more neutral. If it's red, that's kind of indicating negative. And here we can see by the circle that we did downgrade the economic data that's coming in from more positive to a more neutral position.
And that's really just reflecting that while we're still growing, that rate of growth has slowed.
Okay. Good point. The next component of the four are the credit markets. And this one actually got an upgrade. It was gray for one quarter anyway, but has been upgraded. We anticipate it will probably trend back down into neutral, and projections anyway indicate that we think it may be going negative. Again, these are all projected numbers and they are subject to change as new data gets released, but the trajectory nonetheless looks to probably be going down, not up. Valuations have maintained kind of that neutral stance over the last couple of quarters, and we don't anticipate that to be changing. And then the fourth component, market sentiment. And that actually got an upgrade as well from negative to more neutral. And we anticipate actually the trend might be on the positive side there, but that's all subject to change as data comes in. The point here, though, is that if we take these four components and put them into the actual composite, the composite really has seen no change. And we don't expect really any change here over the next quarter or two. But to your point, Jonathan, when we look at this chart, this is really where we start seeing kind of the mixed signals as well. This chart is showing both the performance of the S&P 500, and of course that's done very, very well. It's also showing, though, that composite number with our projections. And you can see that the actual dashboard composite, as well as the 6-month average of that dashboard composite, it's not looking so good. Now, to be a little bit more technical, the current composite is at a specific level. It's 3.26. You can see this at the top right of this chart. 3.26 is still above the 3.15 threshold. Once it falls below that threshold, that tends to indicate more negative kind of directional expectations. The 6-month average is at 3.08, which actually is now below the threshold. So we have one of these data points that's actually above kind of the neutral stance and one that's actually below. So right now, very mixed signals to your point, Jonathan. And I think if we listen back on past webinars, at least the last webinar, if not the one prior, was showing this type of mixed signal as well. So we just don't have a lot of conviction directionally one way or the other.
And to add to that, when we look at some of the subcomponents in each of these categories, there are a number of data points that are really themselves on the threshold. And it really could come down to whether they all turn positive at the same time, whether they all turn negative at the same time. The likely scenario is that we'll continue to see some a bit more positive, some a bit more negative, and we're probably going to hang out at these levels. But it does look like that current could get below its threshold.
Sure. And we'll talk about our bull case, bear case, and base case here in a few minutes as well. So now what we're going to do is drill down into a little bit more detail. So in restructuring the webinar slightly, we start big picture with the dashboard. Now we're going to go to our economic factors, the scorecard. And we're going to start by showing those factors that have shifted from one column to another. And we'll start with housing and fiscal policy. They had been positive. We downgraded them to neutral. And the other downgrade was global growth that went from neutral to negative. And in housing, I think most people probably have seen kind of the headline news. Just earlier this week, existing home sales came out. They're down. I think it was earlier this week or late last week, the IMF came out and cut global growth expectations. So some of this is probably already kind of in the headline news and maybe even working its way into the markets.
Yeah, absolutely. And fiscal policy, again, kind of in that neutral. There are some positives, there are some negatives, but clearly not a positive factor going forward.
The next items we're going to show are the factors that stayed within their columns from last quarter to this quarter. So here in the positive column, we see the credit markets, consumer, employment, and corporate sector. A couple of these actually, although they haven't changed, look a little bit stronger than they did last quarter, like credit conditions as an example. Which we saw in the dashboard was actually positive. Employment numbers have been relatively strong in the last couple of months. Getting back to credit conditions, that's essentially just that interest rates have come down, good point.
which is helpful.
And likely to come down even further when the Federal Reserve meets next week for the Open Market Committee. In the neutral column, the commodity prices, interest rates, U.S. politics, the U.S. dollar, U.S. inflation, and China. Any there that we should touch on? I know there's probably one or two that had some maybe stronger indications.
Yeah, interest rates has a positive arrow. Again, that's just because interest rates have come down, which is really a positive factor, but we're not really thinking it's positive enough that we would have moved it to the positive column.
And those factors that have stayed in the negative column include the geopolitics, tariffs, and the Eurozone. And of course, with the tariffs, we have a down arrow. I don't know that we have another category past negative, but we may end up in that category if things don't come to some type of resolution.
Absolutely, and we didn't really change the arrow, but we'll talk about this a little bit later. But Europe is weak. That's having an effect on global growth, and that's somewhat being impacted because of China. So,
if we look next, again, drilling down into just a little bit more of the details, we have the leading economic indicators. So that's LEI, leading economic indicators. And that's really flattened over the last year. Anything specific you want to speak to that?
Yeah, so it just came down a little bit in June. It's still a very high number suggesting growth. But this is actually a quote directly from the conference board. This type of number, they say, suggests that the expansion in economic activity will continue, but the pace of growth will likely remain moderate in the near term. And that's honestly, we're kind of seeing that across the economy.
Of course, a big driver of the markets are earnings. And we're right now in the midst of another earnings season. What we've shown here are all the prior earnings as well as the forecasted S&P 500 earnings numbers. What did we see so far with this quarter's earnings season?
Yeah, so just to begin with, expectations for the second quarter before earnings were starting to report, they were expected to decline a little bit, and that was the expectation in the first quarter as well. We did see first quarter slightly positive. That's actually the trend that we're seeing so far in the second quarter. So essentially about half of the S&P 500 companies have reported. We've seen some strong reports, we've seen some weak reports, but overall they're showing about 4.5% earnings growth with about 5% revenue growth. When we look at positive surprises, they're about in line with what we saw in the first quarter, kind of in that mid-70s level, and that's actually the level we've seen since 2013. So it looks to be kind of a little bit better than expected, but kind of in line with what we saw in the first quarter.
And the talk of an earnings recession has yet to really materialize.
Absolutely. Now, the other thing, though, we should point out on this particular slide is that while the third and fourth quarter will increase sequentially from the first two quarters, they will show decreasing growth rates relative to last year. So the earnings are coming down a little bit. But when we look out to next year, the expectations are a big jump back to 12% earnings growth. And so
Wow.
we'll have to see, but that's a pretty big expectation.
That might be a little optimistic. But let's hope, right? We always have hope. Now we're going to look at the inversion of the yield curve. And I know we've talked about the inversion of the yield curve probably each of the last two webinars, at least one of the last two. But here we're actually showing the data again. This is the 2-year versus the 10-year. And what do you want to point out with regards to where we are with the inversion of the yield curve?
Yeah, so yes, the main slide we've shown in the past is just the 2-year. This actually also includes the 3-month. So where we're at right now is that the 2-year, 10-year has not inverted, and that's really where most of the evidence indicating future recessions has come from. But what we have seen is that that 3-month has slightly inverted, but actually in the last couple of days, that's come up a little bit.
So we're looking at the far right of this slide, and I'm colorblind, so you'll have to forgive me. But
the green line.
The green line. Okay, so the green line is the 3-month against the 10-year, and that's the one that's inverted, which isn't quite as reliable on predicting recessions as the 2-year versus the 10. That one is still above the inversion. It hasn't yet inverted.
Right, and just as a reminder, historically, when that blue line inverts, we have seen a recession typically half a year to within 18 months after that happens.
Okay. And of course, we already brought up this topic briefly, the tariffs, but this has really impacted the business side of the economy. We're not seeing as big of an impact on consumers yet, certainly not to the extent that everybody was fearful of. But even with the GDP numbers this morning, I think the business investment numbers were down like 5 or 5.5%. And I suspect a big driver of that is the unknown that comes with these tariff issues.
Right, so we're just listing the tariffs when they were announced, kind of what the Chinese response is. So we're kind of on hold right now. However, if the next round does go into effect, it would be an additional 15% on an up to 300 billion in goods. So that would be quite a big increase even from here. And I think that's what people are fearful of as we go into next year, if that becomes the next step.
And this has certainly not just impacted U.S. business investment, which, as I mentioned, is down for the quarter, but it's also impacting global manufacturing, and we're seeing kind of a contraction there. So this chart can get really, really busy. But what we're looking at is down the left side, you'll see each of the countries listed. And of course, at the top, in a columnar fashion, are the years. So if we look to the left, it's pretty obvious the Great Recession really impacted pretty much every country across the board. And you see a lot of red going down those columns. That's not good. And then we come out of the Great Recession, things start getting better, going from red to yellow to green, I would suspect. And then we have some splatters of color throughout. But to the far right, we're starting to see the green dissipate and some of those more neutral colors come in. And the fear is that we might actually start seeing some of the reds.
Absolutely. So as a heat map, you just simply look at kind of the colors. If you look back in 17 and 18, the top half were generally green. That was the developed markets. While emerging never was as good, you did have some greens. But now as you go across through 18 into 19, you're seeing much more yellows and oranges. And right in the middle, you'll see Germany, that last square, very orange. That's basically depicting that their manufacturing economy has contracted. And the interesting thing about Germany is 50% of their economy is export manufacturing related. And so they're really hurting because of the Chinese tariff situation.
Interesting. The next component that we're going to look at is small business confidence. And that still remains relatively high.
Yeah, so for many years it kind of lagged, and then in the last couple of years it's actually been persistently high. You know, it did come down a bit last year from very high levels, but it has slightly recovered. And small businesses still cite finding qualified people for job openings as being kind of their #1 concern. And interestingly, you know, despite what we were talking about mixed signals, the National Federation of Independent Businesses, their quote about the current situation is that overall Main Street is still running historically hot, just not as hot as last month. So this kind of stands out with the consumer.
Now we're going to show a new slide today. We haven't seen this slide. What are we trying to show here?
Yeah, so this is a little bit different. We have typically shown the University of Michigan numbers. So here we're looking at the Conference Board, and there are really two things that we're tracking. If we look at the blue, that's really tracking consumer confidence. The green is looking at present conditions. And what you'll basically see is that
green's the expectations,
the
right?
expectations.
Yes.
Correct. Yep. And what you're going to see is those are much more kind of in that middle of hovering over or below that 100, whereas the present situations or confidence index varies more widely.
More volatile.
Yep, and we're at very high levels currently.
So the point is there's a big spread between what people feel today in their present situation and kind of their expectations looking forward. And because of that big spread, that does raise some eyebrows as we look back, and what you'll see here is the shaded bars going down, those dictate recessions. And if you look here to the far left, when you get a big deviation between present situation and expectations, that tends then to be followed by recession. And it certainly happened in the late 60s. If we look next, maybe a little bit less so in the early 70s, but certainly there. If we look in the late 70s, big deviation again. If we look at in the early 90s or the late 80s with that recession, there was a big deviation between those two indexes. And of course, in the late 90s into the early 2000s, big deviation. And again, right prior to the Great Recession. So not that this is 100% accurate, but it does give us some pause when we start seeing these two indices with such big deviations.
And I think it's important because when we look at the consumer economy, it makes up 70% of GDP.
Yes.
And so that's right now what has been running very good.
Right. Now, we did mention earlier that we are on the longest recovery economic expansion in history. The average expansion is roughly 48 months. Of course, we're going into this one at about 120, 121 months. So that does, again, give some pause that maybe we're nearing the end. Although there is also an argument that because this has been the most shallow recovery, that we could still go further. And what you're seeing here on the right side of this chart are all of the past recoveries from retractions or recessions. And the arrow, the one with the arrow pointing at it, is the most recent. So again, the longest, but it clearly is evident that it was one of the most shallow as well. So with that, Jonathan, let's talk about how the markets reacted during the quarter. We went through all the economic data, which is great, but how did the markets do?
Generally speaking, we saw good, modest returns in the second quarter and across the board.
So we're seeing here all of the equity markets. And I think you've provided us both the second quarter, which, as you mentioned, it was a solid quarter, but the year-to-date numbers are really eye-opening. These are double-digit numbers for basically 6 months of the year. If we were trying to annualize these would be ridiculously high performance numbers. Now, we do have to moderate our optimism a bit, because if we go back a full year and include the fourth quarter of 2018, which was not a very good quarter at all, the returns are down a little bit from the levels of year to date. But still, large cap stocks up 10%, that's pretty much historical average. That's not bad.
Yeah, and then you can clearly see that there are a couple asset classes that are lagging, being small caps and small cap internationals.
Good point. Looking at the other asset classes, we have bonds, which also had a pretty good quarter. Really, the only category here that is showing negative for the quarter was commodities. Year to date, like with equities, we're seeing real strong performance. And actually, even here, when we're looking at 1 year trailing numbers, at least with fixed income, still very strong. And that's because even though equities got hit in the fourth quarter of 2018, bonds actually did pretty well. From a growth and value perspective, we can see for the quarter, growth-oriented stocks slightly outperformed value-oriented stocks, which has been a pretty consistent theme and certainly true for the last year as well. So let's talk about bonds. We touched a lot on the equities. As far as bonds, you say here that falling rates help drive higher returns?
Absolutely. We'll show it on another slide, but across the board globally, we've seen rates come down about at least 0.5%. So when we look at Q2 returns, that certainly fueled relatively strong gains in those bonds. Now, part of that is because there's been questions about global growth, so that's certainly been a factor. And then when you really look at that Q2 return, and then you look at the 1 year return, very, very high. And in fact, we're looking at a couple categories, 3 in fact, being over 10%. And then even if you look at municipal, kind of in that 6.5–7%, think about what that means on a after-tax equivalent yield basis for a municipal. That's roughly 10%.
Really strong.
So very, very strong returns. Again, rates down, some concerns about global growth.
And to the point that you just made, we see globally kind of sometimes a disconnect between all of the various countries and what their Federal Reserve policy is, with some countries being actually negative yields, which is just kind of amazing to think that people would give the government money knowing that they're going to get less back in the end.
Yeah, it's astounding. But again, we've talked about how Europe is a bit weaker. And so when we look at Switzerland, Germany, and France, that's kind of what we're seeing. Japan is actually a little bit negative again. And again, as I mentioned in the prior slide, global rates generally are about 0.5% lower than where they were even last quarter. So now, like a few years ago, we have about $13 trillion worth of sovereign bonds that are trading at negative interest rates.
Yeah, I would have thought we'd never hear of that. Getting back to overall equity returns and bond returns, one thing that we want to be mindful of is to take a long-term perspective and not get too caught up in quarter-by-quarter performance. So what we're showing here is not just the last quarter or year to date or even the last 12 months, but really going back to the beginning of 2018. And you'll see with this arrow here that the S&P 500 certainly up since the beginning of January, but I wouldn't call these like astronomical returns. I think this is about 6% or 6.5%, Jonathan?
Yes, actually, And then here we're looking at bonds, so the U.S. aggregate. That return is actually a little bit higher at 6.9%. Now, if we look at kind of a diversified portfolio, and this would be a globally diversified portfolio, that return is 4.9%. So you compare that these returns relative to what we've seen year to date, very, very big difference. And interestingly, when we kind of refer that back to our dashboard and these composite levels, when we go below that threshold, what we have seen is that we can either see negative returns in stock returns, or more positively, periods where stock and bond returns are actually fairly similar. And that's actually what we've seen in this period.
So just to be clear, because these colors always kill me since I'm colorblind, but the top arrow that we see there, that's pointing to maybe a blue and a green line. And one is the S&P, the other is the bond market. And so they're fairly matched if we look at from January of 2018 to June 30 of 2019. Good point, Jonathan. So let's talk about SilverOak's outlook. We went through the economic data. We went through the market data. From our perspective, as we look at the U.S. economy, while near-term recession risk is low, I don't think we can deny that a lot of the economic data points are indicating slower growth. We've touched on that. And we touched on the inversion of the short side of the yield curve as a concern, and maybe some of the concerns around expectations versus present situation with consumers. Of course, the other saying though on Wall Street is you don't fight the Fed, and the Fed will be meeting again next week, and they're likely to shift rates down. And if they continue to take a more dovish position, that could continue to fuel this economic recovery.
Their goal is to keep the expansion intact. And so in Wall Street language, this would be a soft landing, where growth isn't necessarily falling into recession, but falling from 3% to 2%.
Sure. Internationally, of course, the tariffs we've touched on, and that's really hitting manufacturing across the globe. And Brexit remains a wild card, especially after the recent elections. It pretty much seems like it's a done deal as far as by the end of October deadline, they are going to pull themselves out of the European Union one way or the other, whether they have deals with these other countries or not. But that's, I guess, a chapter yet to be written. Now, this is where I touched on briefly earlier in today's webinar. I mentioned the base case, bear case, and bull case. So we're going to start with the base case. This is the most probable at this point. I don't want to put exact percentages on it, but our base case scenario is low growth, no recession. Basically, Federal Reserve continuing to moderate this soft landing that you just referenced. Of course, the bear case, the kind of worst case scenario, and maybe the second most likely to happen, is that we actually aren't able to enter into a soft landing and it becomes a harder landing and we hit recession, which at some point through normal cycles, you'd think we're going to have a recession, whether it's now or in 5 years, who knows. But a lot of things could contribute to this. Trade disputes, populism, you put falling yields, inverted yield curve, global debt. I mean, there's just a flurry of different things that you could argue could cause or trigger this.
And then on top of that, when you think about our scorecard, we were moving things from the left to the right, so going more neutral. And so we could just continue to see that happen.
Now, I always like to end on probabilities with the best case or the bull case scenario, which is maybe we get some low growth, no recession, and then a reacceleration of the economy. And certainly there are scenarios you could paint that could lead to this, and you know, we would encourage that type of
it would be great
trajectory.
I think what we're talking about here is the consumer continues to be strong. U.S. small businesses continue to be optimistic. And then we get some sort of trade resolution with China, and we see Europe start to recover a little bit.
But of course, this brings us to next year. And I always like to remind folks, and we talked about this in the last webinar, you should maintain a consistent investment strategy, regardless really of the politics and what's happening in the economy, or what you might see from month to month or week to week or even quarter to quarter in the markets. Maintaining a consistent strategy and not allowing maybe your politics to overly influence your investment decisions, or economic data to maybe over influence your investment decisions. Because although there's some correlation, it's surprisingly small from year to year. More specifically on bonds, our outlook what? Is for continued lower rates?
Yes, generally speaking. And a lot of that will somewhat be determined by what sort of global growth we see. If we see global growth and concerns continue, we could see them fall a little bit more modestly from here. If we see growth come up a little bit, we could actually see the longer ends of the yield curve maybe come up a little bit. And interestingly, when we talked about the fact that the 3-month and the 10-year just came positive and isn't inverted again, that's kind of what is going on, is we did see those medium rates come up a little bit.
Okay.
So those are the things that we're watching. But again, what you have talked about in terms of maintaining focus is we want to maintain focus on credit quality, good solid bonds without taking a lot of risk. And as we saw last year in the fourth quarter, having that type of strategy, bonds did offer the protection that we really look for in a portfolio.
On the equity side, it does look like valuations are reflecting a lot of good news. Again, the Federal Reserve could be on the side of the markets if they continue to take a stance of lowering rates. We've talked a lot about what's happening internationally with Boris Johnson being elected for the Brexit, the China tariffs, things of that nature, and of course the 2020 U.S. presidential and congressional elections. So maintaining that diversification, as we've alluded to now a couple of times, is probably more important than really ever as we go into some quasi, in quotes, uncharted territory. Other SilverOak updates and reminders. First, I want to welcome Alec to our team. We've hired a second associate paraplanner, and he is now, I think, ending his first week with us. So welcome, Alec. We enjoy having you on the team and look forward to many more years. From an IQs, or investment quality scoring system perspective, we continue to consolidate several positions that weren't really widely utilized within client portfolios. And we have on the cusp the release of a couple of white papers, one on international investing and a second on behavioral finance that I know, Jonathan, you've been working with John in kind of putting the final touches on. So thank you to our entire team in putting those white papers together. I know John does a ton of work. They seem so easy and they kind of flow so well when you get to the final product, but there's a lot that goes into making that look so easy because it's really not. As far as reminders, we always like to remind folks to periodically review their estate planning documents. So we hadn't touched on that for the last few quarters. So this is just a reminder, if you haven't reviewed your wills and trusts and power of attorneys and healthcare directives, things of that nature. If you haven't done that recently, you should. As far as tax planning, it's mid-year. Great time to put together a tax projection so there are no surprises come February or March or April of next year. We're already doing this for many of our clients that we do tax preparation for. Begin to think about enrolling in 2020 deferred comp plans. I know maybe it's a little bit early to think about this, but usually in the September, October, November timeframe, you'll have those elections to make. And then the Minnesota conformity rules. They were enacted on May 30th. It's interesting that many components were made retroactive to actually January of 2018. Now, the good news is a lot of the components that were made retroactive actually deal on the business side. And for the individual side, most of the components are going to be enacted for 2019. And we're still going through all of the details as to which ones are 18 and which ones are 19. But the big changes include these items. One, the standard deduction has now been increased for Minnesota, matching the federal. Second, the itemized deductions generally match the Tax Cuts and Job Act, which means property tax deductions capped at $10,000. Charitable contribution deductions actually increased to 60% of AGI rather than 50%. Home mortgage interest deduction, you can now only take interest deductions on up to $750,000 rather than $1 million of new indebtedness. The medical expense deduction now needs to exceed 10% of AGI. I believe the earlier number was 7 or 7.5% of AGI. So a slight change there. Minnesota also eliminated personal exemptions, but they did maintain the dependency exemption. They also decreased, surprisingly, the second tier rate from 7.05 to 6.8%. Of course, that last one on the tax rate decrease, that one for sure is not effective until 2019. We know that for sure. Alimony, here's a big one. If you are entering into a new agreement, not old agreements, but a new alimony agreement, it's no longer deductible by the person paying the alimony, and it's no longer non-taxable to the recipient. So now the recipient has to report that as income. That one honestly was a big change for a lot of people. And then 529 plan dollars can be used for K to 12 education expenses, at least up to $10,000. So those are a couple of the highlights. There's going to be more information coming out. Honestly, Minnesota Department of Revenue still is working on putting together amended forms and sending out that information to all the software providers. So there's plenty of information yet to be released on that new conformity law. Lastly, if there are any additional questions, please reach out to your SilverOak advisor. If you have suggestions for topics in one of the future webinars, reach out to your SilverOak advisor. And if you're not working with an advisor, feel free to contact me directly at the 952-896-5701 number. So with that, we want to thank everybody for their time today and hope that you have a great afternoon.